this certainly hasn't been an environment where bonds are going into long-term treasuries or something like that is going to be the offset to your volatile stocks in a diversified portfolio. And the way we have been positioning ourselves has been much more biased towards the short end of the curve, as they say, which is very like treasury bills. And just looking for yield is still high, right? On cash, like cash still pays a good amount of yield. So that's basically where we've been hiding out because the volatility in the rest of the curve, as they say, like in longer term bonds, has been unprecedented, or not unprecedented, but usually only found in a like in a 2020 to 2008 type of environment where credit all blew up. So we've been just focused on the short end of the curve. And if you looked at like a chart of the curve, so when they say the curve, it's like what yield is on a 3-month treasury, what yield is on a 2-year treasury, what yield is on a 10-year, a 30-year, and you kind of set this like line of where yields are. Twos and tens have been shifting up and down together, but the 3-month and 6-month, it's kind of just been staying locked where it is. And so there have been moments where there was an inversion briefly between the 3-month and the 10-year. And inversion means that the 10-year is paying less than the 3-month. That's not, shouldn't, it's not rational, but it usually happens before a recession. So the market is going in and out of like recession, no, recession, no. And it's showing up in the bond market there. So we've just been hanging out in the short end of the curve and not trying to be fancy or, it's just not, it doesn't feel worth it to me.